Hi guys, welcome to my channel. I hope you're all good. So today we have got a jargon busting video. So you might be buying your first home or buying your first investment property, and I thought I'd just come and explain some of the keywords and phrases that will come up during the buying process. I know it might feel like quite an overwhelming thing, and obviously if people are using words that you don't understand, then that is not going to help the situation at all. But before we get into the video, make sure you give it a big thumbs up and subscribe. That would really help me out. Also, I've tried to put these words in order of where they'll come up in the buying process just to make it a bit easier. So, first word, vendor. Vendor is basically just another term for seller. So, a vendor is the person who is selling the property. So, what is a freehold property? A freehold property is basically when you own the property outright and you also own the land that it sits on. So, you own the garden, the driveway, you own everything. So, a leasehold property. This is more common when it comes to flats and apartments because you buy the flat or the apartment, but then you don't own the whole building and you don't own things like the grass outside, the car park and things like that. You just own your flat. Leasehold is kind of like buying a very long-term rental agreement, and you're basically buying the rights to use that property as your own. You do occasionally get leasehold houses, but this is less common and the government are trying to phase them out. So a house deposit. A house deposit is basically the amount of money that you're putting towards purchasing the property because you won't be able to get a mortgage to cover the full amount. The amount needed depends on if you're a first-time buyer, if it's an investment property, or if it's your second home, but it's usually between like 5 to 25% of the purchase price. So let's just keep the numbers real easy. Let's just say that you are purchasing a property for 100 grand and you put down a 10% deposit. That means that you need to save 10 grand to put towards that property. So what is a mortgage? So a mortgage is basically a loan that is given to people who want to buy properties. So let's stick with the 100 grand property. Unless you've got 100 grand cash to buy that property, then you will need to get a mortgage. So you might put in a 10% deposit and then get a mortgage which is 90%, and then you pay back this 90% plus interest, usually for 25 years. And a mortgage is secured against that property. So let's say, for example, if there's an extended amount of time that you can't pay your mortgage back, then the lender will be able to take the property off you and sell the property so that they can get their money back. So I do also have a video with my mortgage broker answering any mortgage questions, so be sure to check that out. So interest rates. This is basically a charge for borrowing the money. So let's say that interest rates are 4%. You would then have to pay back your mortgage plus 4%. So a decision in principle. This is basically something you get from mortgage lenders to say how much they'd be prepared to lend you before you go through the whole process. So whoever's sorting out your mortgage, whether it's a bank or a mortgage broker, they'll want to find out about your financial situation. So they'll be asking about your salary, how much of a deposit do you have, and they'll look at things like your credit score. Then they'll basically write you a letter or an email to say, okay, we'll basically be prepared to give you a mortgage of X. So what is a valuation? So when you're buying a property, you have to have a valuation done by the lender. And this way they know how much your property is worth and what to base your mortgage on. As I said before, mortgages are secured against the property. So if there was ever a situation where you couldn't repay the mortgage for an extended period of time and they had to sell it on, the lender will want to know how much the property is actually worth, just in case they had to sell it on and get their money back. And a valuation will really depend on other properties in the area and how much they've sold for, the condition of your property, and of course the economy. You can actually end up in an unfortunate situation, which we ended up in on the last property that we purchased, where basically the valuation came in lower than the price that we'd agreed to pay for the property, which was just an absolute pain. But I'll leave a link to that video in the description bar down below because I don't want to confuse anyone on this video. So LTV, this stands for loan to value, and this is basically the proportion of lending they're prepared to give you against the value of that property. So the higher the loan to value, the more riskier it is for the lender. And this is given as a percentage. So what you do is the mortgage balance divided by the value of the property times 100. So let's stick with our 100 grand house. So let's say you have a mortgage of 90 grand. You would divide that by the value, which would be 100 grand, and then times that by 100 and get an LTV of 90%. So lenders will see a higher LTV as riskier because let's say, for example, you're in a situation which I hope doesn't happen, but let's just say your house gets repossessed. and they have to sell the property on. If your property has got 90% LTV, that means they need to recover 90% of the costs. Whereas if it was 75% LTV, then that means they need to recover 75% of the cost. I hope that makes sense. Like, honestly, I don't want this to confuse anyone. But if we stick to the 100 grand house, it's basically the difference between them having to recover 90 grand or 75 grand, if that makes sense. I'll make sure I leave some like illustrations on the screen because honestly, I don't want this to confuse anyone. So yeah. So what is equity? So this is basically the difference between the value of a property and how much you owe on that property. So it's kind of like how much cash would you have left if you chose to sell up. So as time goes on and you start repaying your mortgage, then the amount of equity you have will increase. And obviously over time, properties will go up in value. So again, that gives you more equity, which we love that. So what is a bridging loan? So this is a short-time loan that is typically used on properties that require refurbishment. So it could be used when doing buy, refurbish, refinance deals or when doing flips. And with bridging, the interest rates are typically higher than a mortgage. So it's the type of thing that is definitely short-term and you just get on the bridge and get off the bridge as soon as you can. But I do have a video with my broker talking more about bridging finance and bridging loans if you wanted to know about it. So I'll leave a link to that in the description bar down below. So what is a survey? So this is something you have done to identify any major structural issues. And in terms of structural issues, this could be things like subsidence or any unstable walls and things like that really, so that you really know what you are dealing with. So what is a chain? So a chain is basically where there's a group of buyers and sellers all dependent on each other's properties to be bought and sold. So just imagine if you're looking to buy a property, the people who are in front of you in that chain, they've also got to find a property to buy, and then the people in front of them, they've also got to find one to buy. And then obviously some people in that chain will be relying on the sale of their house to enable them to buy the next house. So that's why chains can kind of get complicated. And this can actually cause deals to fall through because you're relying on other people. So yeah. And also if there's one household in the chain that is really slow, then the progress of you buying your property is dependent on the slowest people on the chain basically. So they could be holding everyone up because they haven't like signed a document or something like that. And yeah, they'll basically be the ones slowing everything down. Luckily for our investment properties, we've never been in a chain, but I know that my mum and dad, when they bought their house like literally 10 years ago, they were in a chain. And basically mum and dad found a house that they wanted to buy, and then we also found someone who wanted to buy our house, so we were like, oh amazing, and things were progressing and everything like that. And then all of a sudden the house that we wanted to buy, they didn't want to sell it anymore. Like they were going to move to France and then they decided not to. So then we were like, oh my god, like we need to, obviously I wasn't getting involved because I was only like 10, but we were literally like, oh my god, we need to like buy a house like quickly. So you can kind of see how deals would end up falling through, because imagine if we weren't able to find a house to buy quickly, then the people who wanted to buy our house would have been like, what we're gonna do. So yeah, chains can definitely get very complex. So EPC, this stands for Energy Performance Certificate. This basically gives information on how energy efficient a property is and will give an estimation on how much the bills will cost. I'll leave the little graph on the screen so you can see what it looks like, but basically you get given a rating between A to G, and A is the best and G is the worst. So next is the Memorandum of Sale. Oh my god, that is such a mouthful. I've just had to try and say that like 10 times, but it is the Memorandum of Sale. So basically this is something that your estate agent will draw up once the vendor has accepted your offer. So you've gone for the viewing, you've liked the property, you've put an offer in, and then if the vendor accepts it, the estate agent will draw up the Memorandum of Sale. And this is basically to say that the property is now under offer and to get the process started. And this will be sent out to both your solicitor and the vendor's solicitor, so everybody just knows that the process is actually starting. In the Memorandum of Sale, this is where they'll also list any like terms and conditions. So say for example, if you buy a property but it's subject to planning permission, then that will be in the Memorandum of Sale. Why do I keep saying that word when it's so confusing? So what does under offer mean? So this means that the vendor has accepted your offer and everything is in progress, and you are now officially in the process of buying a house. Yay! So this is when you start going through the legal process, when you start sorting out your mortgage or bridging finance, whichever one you need to get. This is where it all happens when you're under offer. It's important to know that while you're under offer, the deal can still fall through. So at any point while the property is under offer, it can fall through for whatever reason. So exchanged. So this is officially when the contracts are exchanged and there is no backing out. So before this point, the deal could have fallen through at any moment in time, but once you've exchanged, there's no backing out. And this is also the point where you would send your house deposit over. So completion, this means that everything's done, everything's gone through, and the house is now yours. You can take your little Instapic with the keys like, hey. But yeah, the property is officially yours. The time between exchange and completion can vary. It could be a few days, it could be a few weeks. Actually, when we were in the process of buying our first investment property, we'd exchange and we'd send the money over, and then our solicitor went to the flipping Maldives. And like literally no one else in the company could put the property through, so we were just waiting for her to get back off holiday. So yeah, it just really depends. So the word title basically means ownership. So what is the land registry? So this is basically where the information of who owns property and land is held by the government. So they keep all of the information on an online database and anyone can access it. So let's say for example, you want to buy a property that you know is empty, so you can go onto the land registry and type in the details of the property, so it's like the address and things like that, and find out who owns it. I think it costs like, I'm gonna say £3 to find out the details of who owns the property. So stamp duty, this is basically a tax that is added for buyers when they're buying a residential home. And it's a different amount depending on if it's your first home, second home, and how much the property is worth. However, at the time of recording this, there is reports that there will be a stamp duty holiday where the thresholds for paying stamp duty will be increased, which is absolutely amazing. So guys, that was the jargon busting video. I hope that's helped some of you guys out. If there's anything that you want clarifying, then be sure to comment down below. If there's any videos you want me to make that would help you guys out, then again, let me know. But thank you so much for watching. Don't forget to subscribe and give this video a big thumbs up. And I'll see you next time. Bye. So when you're buying a property, you have to have so next is the oh god, I can't say it. So next is the why can't I say it? I said it perfectly before. Don't test me.